And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. It's, of course, Danny Ratliff joining me today. It's also the day before Halloween, so very excited. I get to dress up tomorrow. I dress up every year. You don't know this? I thought you knew this. I dress up every year for Halloween.
Not for the show.
No, not for the show. I dress up for Halloween when all the kids come by. So
that was the meaning implied.
No, gotcha. No, I dress up every year for kids. So last year I was Venom from Spider-Man, Dark Spider-Man. So anyway, so last year I was Venom. This year I'm going to be Master Chief for Halo. So
very good.
I've got this really cool outfit for it. So anyway, but I've got a new neighborhood, new kids, so I'm going to terrify them.
Fresh audience.
Exactly. Fresh audience. Anyway, it's all good. Anyway, so yes, Halloween's tomorrow. It's supposed to rain, unfortunately. If you live in the Houston area, we'll hopefully, they said that maybe it'll kind of let up, by the time it gets dark for trick-or-treating. So, we'll kind of keep our fingers crossed. Yesterday, of course, earnings have started to roll in for the big mega caps. Google reporting earnings. Basically did extremely well on earnings. Earnings were great, beat estimates, lots of positive talk about AI, etc. And the stock's going to be up about 5% today open, so that's going to kind of lift the whole NASDAQ with it this morning. AMD, on the other hand, also, by the way, we have shares of ownership in Google, just full disclosure. AMD, we also own that one. Actually announced very strong results yesterday. Earnings were good. Growth doubled in terms of sales. So again, everything's kind of firing on all cylinders. But their guidance, they basically didn't raise guidance. They just said our guidance is still good. And that kind of disappointed Wall Street on that front because they were hoping for a big upgrade to their guidance. But they're still expecting a doubling of sales. So again, nothing fundamentally wrong with the company, but AMD is going to be down this morning on that news. So a little bit of a mixed bag. Now today after the bell and tomorrow we've got Apple, Microsoft, Amazon. So kind of got some more of the big boys coming out over the next 2 days. That's going to be really kind of driving the market into month end in particular. So outside of that, of course, everybody's kind of starting to really focus on the election. Yesterday there was a 10-year bond auction, went extremely well. Big stop through on the bid. So again, a lot of demand for 10-year treasuries yesterday. That lifted yields into lowered yields into the day, lifted bond prices. But this is a little bit of that pre-market hedging that we've been kind of talking about, this pre-election hedging. Markets have been very kind of one-sided over the last several weeks, very long equities. There's not been a lot of risk reduction in portfolios, so not surprising we might see a little bit of volatility pick up over the next couple of days into the end of the week, ahead of next week's election, just in case, right? So kind of expect a little bit of volatility. Markets look to open down this morning a bit on the Dow anyway. The S&P and the NASDAQ will be up because of Google this morning, but the Dow's looking to open down about 70 points this morning. Again, outside of that, the economic data continues to be okay. It was interesting yesterday, though, the JOLTS survey came in much weaker than expected. There was a very, very big drop in the job opening, labor, and turnover survey, really kind of across all measures, whether it was hiring or job openings, et cetera, all really took a very big drop. And we saw negative revisions to prior data. So that data certainly did not bode well for this idea that we're having this surging kind of booming economy. That also brought down the Atlanta Fed's GDP estimate for the third quarter to 2.8%. That was above 3. It's at 2.8%. We're going to get this morning the advanced reading for the Q3 GDP. And so that's expected to come in at 3%. So we'll see what that looks like when that's reported. But again, there's nothing wrong with the economy, but there's a lot of expectations that the economy is just really growing very strongly and will continue to grow strongly into next year. but we are seeing some evidence that that may not actually be the case. But that's for a conversation later. Here's what you need to know before the bell this morning. Markets continue to do very well. Interestingly enough, the consumer confidence report came out, the Conference Board consumer confidence report came out yesterday, showed an increase in consumer confidence a bit over 100 yesterday, which was a nice reversal, but we've seen this bounce before. Consumer confidence remains in a downtrend, but it's going to bounce on the way down. But anyway, we did see a bit of a bounce yesterday in consumer confidence. Both the present and future expectations indexes increased as well. But the fascinating one was, despite the fact that consumer confidence remains fairly low, their confidence about higher stock prices over the next year just hit a record high. So, I mean, consumers are extremely confident about the stock market just continuing to rally here into next year. And again, though, but we have this kind of same reflection in the markets. Markets just continuing to hold on to this 20-day moving average. Nobody's really willing to buy or sell right now. It's just, we're kind of just stuck until we get into the beginning or past the election. So again, markets just really kind of stuck here at the moment. But again, we're just holding right along this 20-day moving average, not really traveling anywhere to any great degree. Again, this is going to break one way or the other depending on the outcome of the election. We'll just have to wait. Again, as we talked about, remain on a sell signal. Markets are not extremely overbought, but they're not oversold either. Again, we're just stuck in limbo. This makes it kind of difficult to trade portfolios. Moving over and looking at emerging markets, international markets as well. Not a lot going on in international markets. They just continue to be on a sell signal here, kind of languishing. Emerging markets also just kind of just had a nice little rally, but have been selling off here as of late. Again, but you've got to be careful with this. It looks like, oh yeah, emerging markets are doing very well. The problem is that if you back this up to basically a longer term graph, they're not doing anything. So, this is your peak back in 2022. We have far surpassed that in the U.S. in terms of the S&P 500. Emerging markets just really not doing a whole lot. Have been a real drag on diversified portfolios as well. And this is why we've talked about before. Make sure that when you are running a portfolio, diversification is fine, but that doesn't mean just buy a little of everything and kind of hope for the best. Diversification means also making sure that all your assets are performing at the same time, because you want to have relative performance. And if you have a big break, that's going to be a problem. The dollar's continued to kind of strengthen here as of late. We've had a very nice strong rally in the dollar. That's been helping as inflows continue to come into the U.S. The U.S. is now about 63% roughly-ish of global market cap. So again, if you've got reserves anywhere in the world, you want to and you want to have them in a relative place of safety, the U.S. is the only choice. We make up, again, a huge chunk of global market cap in financial markets. We've got the most liquid bond market. Stability in terms of economic growth relative to the rest of the world. The U.S. economy is still growing. Britain, France, Germany, those economies are not growing at all. They haven't grown in like 2 years. So, there's just this big bifurcation between what's going on in the U.S. and that continues to track foreign inflows into the market. So again, just, these are things that are just continuing to kind of drive the markets right now. But again, everybody's just kind of waiting. It's kind of interesting. Danny and I are going to talk about this morning. Everybody's got this attitude of just, I'm not doing nothing until after the election. And the market's doing that very same thing right now. So just sit tight. We're going to have to wait. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hang on a second. Danny was bugging me this morning. I didn't get my coffee yet. So yes, as we were talking about here, it's interesting that the market's really just not doing anything. Everything's just kind of sitting still at the moment. And we're just, it's interesting. And Danny and I were having this conversation this morning, and I've had the same conversation with quite a few prospects that I've been talking to lately, clients as well. Nobody just wants to do anything right now. They're just like, I'm not doing nothing till after the election. And it's kind of an interesting dynamic because the whole market seems to be set up this way. If you take a look at the stock market positioning is very elevated, but also hedges against the stock market are very elevated. So we're long the VIX and we're long equities kind of simultaneously. It's just kind of an interesting dynamic. You don't see this very often. What that does mean though is it does change. So the one thing to be careful of here is what happens after the election, and there is a potential risk to investors that if you're very long one asset class or another, that you could see a big reversal depending on the outcome of the election. But again, nobody knows what that's going to be for certain, and that's why nobody's willing to do anything. It's just going to have to be kind of a wait and see moment. Just be aware that come Wednesday, Thursday, Friday of next week, we could see a big change in the market. Plus the fact, don't forget, is that not only do we have the election Tuesday night, Wednesday you have the Federal Reserve meeting, which they'll announce their next policy. So on top of an election outcome, which may possibly be contested, and we may not know for several days, while kind of guessing. The one thing we will know for certain very quickly Tuesday night is who controls House and Senate. We may not know who the president is for several days or several weeks, depending on what happens.
Or months.
I
hope not.
Well, it'll get settled by December. Yeah. Because eventually Congress will settle it, if nothing else. But we will know who controls House and Senate by Wednesday. And then you're going to have the Fed meeting talking about the next policy. That could also drive markets because, again, if the Fed comes out and says, hey, you know what, we cut rates and actually everything's okay, we're not going to do anything right now, that could really disappoint the markets. So there are some, I know everybody's focused on the big risk of the election, but there's also the Fed risk, which is just sitting right around the corner as well.
Well, we've got a whole lot of economic data coming in this week as well.
Right.
So,
employment data on Friday?
Yeah. Employment data, more big tech earnings, AMD disappointed overnight. All the things you just talked about. But, we've also got to think right now, CME FedWatch has a 100% chance that they're going to cut by 25 basis points come next week. Political posturing right now is a real problem. So what Lance is mentioning is that the inaction or the inability to say, you know what, I'm going to wait, the inability to go and put funds to work, I completely understand, because this can go many different ways, right? If Trump wins, likely U.S. stocks perform well. Probably Bitcoin continues its surge. You know, it's interesting. We saw interest rates on mortgages were hovering around 7% once again. Mm-hmm. And everybody says, well, that's an indication that they think Trump's going to come in and win, and it's going to keep these rates higher.
Which makes no sense whatsoever.
Correct.
Yeah.
No, I get it. But the guy that they quoted for the article is also the economic advisor for the Biden campaign or the Harris campaign. And, you know, he was an economic advisor for Biden. So you got to be careful with what you read. I thought that kind of funny. I was reading it and I was like, wait a second, who is this guy? This doesn't add up. But
and that's the problem with a lot of the data that comes out right now. You've got to be careful of, you know, what you're reading. I saw an article that says like 33%, the 33 economists all state that if Trump wins, we're going to have massive inflation. But then you go back and look at the data during his presidency, and we had no inflation, and stock markets did well.
Well, there's a big difference between data and opinion. And the problem is that many people, you know, confuse the two, and the people that write it themselves as well. So, you know, if we look back right now, I know there's a big concern about bonds and interest rates. We hit that 4.3 range. And so everybody's saying, well, look, this is a technical indicator that rates have to continue higher. That's not necessarily the case. In fact, if you go back over the last 35 years, this is the first time that we've seen rates spike like this after a rate cut. I mean, total counterintuitive to what essentially they're trying to accomplish here. And so, you know, there's a lot of mixed feelings, I think, that are out there. I understand, you know, wanting to wait and see. I'm not saying anything bad about that approach. But you and I were talking about this the other day, and from a market perspective, you may be left behind, or you may be very, very happy that you didn't do much, right?
Right.
Harris wins. It's probably a continuation of the Biden, administration's what exactly they've done, and so Asian markets likely to continue to do well or better than what they have been. So, you know, I think that there's not a lot of major moves that need to be done, and like you said, it's kind of easier to kind of sit on your hands and wait at the moment. But I think there's going to be a lot of opportunities out there, and there may be a lot of money that flows into different areas because of how this election goes on Tuesday.
Well, and definitely what will happen is that money will definitely flow into areas that, you know, again, you know, based on who wins, what their policies may be. Yep. Now, whether or not they can pass those policies is an entirely different thing, right? So again, if you know what markets love, and I posted this analysis yesterday, but markets love gridlock. So the markets perform the best on average when you have a Democratic or Republican president, really doesn't matter which one, but then you have a split House in Congress. So basically nothing gets passed. Markets tend to perform best in that environment. But, you know, if Trump gets elected, then you should expect to see money rotate into technology, finance, and energy. If Kamala Harris gets elected president, then you should expect money to flow into things like healthcare, clean energy, those type of things, because those are the policies that she'll want to promote, right? So same thing for Trump. So Wall Street is, you know, currently positioning what appears to be positioning in more of a Trump trade, right? We've seen technology do better. Healthcare has been underperforming. It's been lagging a lot over the last month. So we're seeing that kind of positioning by Wall Street. But again, this is one of the risks we've talked about, is that if there is a surprise outcome of the election that goes, you know, again, Wall Street's kind of positioning, it appears to be, for a Trump victory. But if Harris does happen to win the election, then all of a sudden those trades have to be reversed. So there could be a very big reversal in the markets just as those trades get unwound and get replaced, you know, in healthcare, right? Goes out of tech and into healthcare, that type of thing. So just things to be, you know, careful about as we move forward. One thing I wanted to touch on this morning, Brent can bring up this chart for me real quick. No, I wasn't on that. I was looking for something else, but that's the chart I want. But I saw this morning, and Visual Capitalist does great work. So I tweeted out and said, this is really bad analysis by Visual Cap. The data is correct. But what this chart shows, and we see these articles out every year talking about, active versus passive and why you should just be a passive investor. The problem is they always do this analysis, which shows that, how many active funds outperform the index in a given year versus underperformed. So the gold is underperformed, the green is outperformed. And every year, a large majority of funds underperform their benchmark index. What this data doesn't tell you is how many of these were the same managers every year. Yes, in any given year, managers are going to underperform an index for one reason or the other. What this doesn't tell you is which managers consistently were in the outperforming category or underperforming category. Because again, out of all those years from 2001 to 2023, there may be managers that outperformed in 15 of those years, but in the other 5 or 6 years, they underperformed, right? So it says this doesn't give you any indication. Yes, it just says a lot of managers underperformed. Okay, great. Which ones? Because if I go back and invested in the long term with people like Peter Lynch, with Fidelity Magellan Fund, or Sequoia Fund, Berkshire Hathaway, Warren Buffett, he's underperformed. Warren Buffett's underperformed in years, right? But if you'd invested with him long term, over 20, 25 years, you've done fantastically well. You've killed the S&P 500, right? So this is the important thing about, understanding. And this is one of the big problems with Morningstar. If you ever look at, a lot of people say, I bought this mutual fund because if you look at the Morningstar track record over 1, 3, 5, and 10 years, it's always outperformed. Well, that's assuming that you've held the fund for 10 years. Right? It assumes that you bought the fund 10 years ago and you've held it for 10 years. And so, yes, it's outperformed over 1, 3, 5, and 10 years. But what happened if you bought it in year 6 or in year 4, in between those 1, 3, and 5 year periods? Your performance will be vastly different. So, we've always got to look at specifically the fund manager that we're looking for and say, okay, I'm looking for a fund manager to do this in this particular area of the markets, and look at how they did in each given year, right? You have to actually do your homework, which is, I know it's hard to do, but look at fund managers that have done very well. Another big problem with Morningstar is that people go, well, I bought this fund because it's 5-star rated. You don't want to buy 5-star funds. The reason you want to buy 5-star funds is they're already huge funds. Their ability to grow and to really take on bets that are going to make you a lot of money, they can't do that anymore. They're so large, they can't make those opportunistic bets. I want to find the 1-star fund that's on its way to being 5 stars. Right?
Well, I don't mind the 5-star funds so much, but we're looking backwards, right? That's the problem with Morningstar is that we're not looking forward. Okay, has there been a big manager change? What is the risk here?
Right.
How quickly does Morningstar actually go in and review that data? I mean, we look at a lot of bonds and we want to look at what their ratings are. Some of these bonds we look at have not been re-rated since the financial crisis, right? So
ratings are terrible.
Yeah.
They're even worse than manager ratings.
But I think you have to do your homework as well, as that if you're looking at any of these agencies, how quickly are they doing this? How quickly is Morningstar making changes?
Yeah.
How deep is somebody's bench? Bill Gross leaves PIMCO. That bench was so deep it did not impact any of their ratings.
That's right. And again, the problem with the ratings on bonds is they don't get rated until after they blow up.
Yeah. Thanks a lot, guys.
Yeah. And well, it's also depend. We'll talk about that. If you don't understand bond ratings, we'll talk about when we come back from the break. That's called pay for play. We'll talk about that. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife and I are in a huge fight. She says I absolutely don't love her anymore. And I said, honey, that's not true. I just said you can't put the Christmas tree up yet. It's not Halloween.
Does she want one tree or both of them up now?
She wants them both up. We compromised with Thanksgiving stuff on the table and Halloween stuff in the living room.
The Real Investment Show podcast. Same show
Yeah, I'm surprised she's not wearing her Christmas sweaters yet.
at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So real quick, got a question in chat I want to go over also, just because it was a good question talking about why don't we talk about intrinsic value, and that's a good comment.
Because it doesn't matter right now.
And there's your answer. So the short answer is it just doesn't matter right now. But no, intrinsic value does matter. But real quick, I said we talk a little bit about bond ratings because this is important to understand. Is that, again, kind of when we're talking about fund managers and when you go out to pick a fund manager, be careful with the ratings. They don't tell you as much as you think about fund managers, and be really careful of past performance. There's a reason that there's a big disclaimer on everything out there that says past performance is no guarantee of future results. So when you look back at a fund that's done well over the last 1, 3, 5, 10 years, this thing has been absolutely killing it over the last 3 years, right? As we talked about before, that typically occurs within a cycle of some sort, and then you're about to go through a cycle where it's going to underperform for a period of time. And this is why so many individuals buy things that they regret because they buy what was hot last year or the last 2 years, and they're buying it right at the peak of exuberance. And so if you take a look at any asset class, it doesn't matter what it is, whether it's stocks, bonds, gold, whatever, if things are really, really exuberant, you're probably going to have very disappointing returns over the next period going forward, simply because of reversal of that exuberance. It's just everything ebbs and flows in the markets, and you just need to be aware of that. That's just the way markets work. Nothing goes straight up forever. And when things get really exuberant, then that's when you have much bigger drawdowns and corrections over time. But bond ratings are pay for play. So if I want to issue debt, right, so Danny's the rating agency. I go to Danny's bond rating agency and I say, Danny, I need you to rate my bond. And Danny says, okay, great. It's going to cost you X thousands of dollars for us to do the research and rate your bond. So I'm effectively paying for that rating. And if I'm paying for it, I probably should get a good rating, right? So, that's the problem with these rating systems. And the other problem that comes along with that is that these ratings aren't evaluated on a real-time basis. So as things are devolving within a company or whatever it is, the rating doesn't change. I'll give you a really great example of this, personal example. We own some bonds of a particular company. I'll tell you who the company is in a second. Bond was AA rated, paying 6% at the time, 6% corporates. It had 2 years to maturity, and balance sheets were okay, right? Because we do our research. What we didn't know at the time that we had bought the bond about 12 months earlier. And what we didn't know at the time when we bought the bond was there was a problem with underlying credits. We couldn't see it. It was not in the data, and we couldn't see it. In fact, nobody could see it. The problem is that on a Friday, the next morning, the company was forced into bankruptcy by the federal government. That company was Lehman. There's some risk that you just can't factor for. Now, the bond was AA rated on Thursday. On the following Monday, it was bankrupt. There was no rating change going through that process. And this happened across, that was just Lehman. That just was a bond that we happened to own at the time. But that happened with all the mortgage bonds back in 2007, 2008. Danny will tell you this, is that all the mortgage bonds were AAA rated at the time. Nobody was downgrading mortgage bonds real time to adjust for underlying subprime credit destruction that was going on within these categories. After the fact, after everything blew up, then the rating agencies go, oh yeah, those are no longer AAA rated. Well, thanks a lot for the help. We appreciate it.
Yeah, because they're not here.
Exactly.
Thank you. Your job was very difficult.
Yeah. So just the point is that ratings happen in the rearview mirror. They're not beneficial for you in terms of, oh, I bought this bond because it's A rated. That's not beneficial for you. You've got to actually do the work. And this is incredibly important if you're buying quote unquote high yield, that marketing term for junk bonds. If you're buying a high yield fund, you need to really understand what's in that high yield fund, because high yield is fine. High yield is a proxy for risk when markets are going up. People will buy junk bonds as markets rise because they're willing to take on more risk. But when the markets crack, the whole reason those are junk bonds is because they're already on the verge of bankruptcy. Those are the ones that tend to go out of business the quickest. So again, you've got to do your own homework when buying debt or anything like that's rated. Understand what the actual rating is about.
Yeah, and I think a really good point you made was that these companies are doing this, as they're spending money to become rated so they can actually market their fund or their bond better. And if they have a hiccup or they have any hurdles they have to overcome, you think they're spending that money if all of a sudden, revenues aren't as good, things don't look as good on the balance sheet? They're not going to spend that money on being re-rated because they still want to sell as many of those bonds as they can.
Mm-hmm. That's right.
So that's why it's in the rearview mirror. But I do believe that's a great point. Those rating agencies, they make for a tough go because we put so much into them. And even going back to, the conversation started with just Morningstar, looking at 5-star funds versus 1-star funds. And look, there's a lot of 1-star funds out there that are 1-star for a reason. And they'll likely always be 1-star. But going back to that chart, one thing you didn't mention, so Lance had a chart last segment up that basically showed, under and over performance of fund managers versus the S&P 500. And they don't account for the fees.
Right.
There's always going to be a difference between you and the market. Even if you're an SPY, just an S&P 500 fund, there's a small expense ratio. So that in of itself would indicate you're going to have a slight underperformance.
That's right. No, that's a huge point. And I've talked about that before.
Yeah.
Is that, everybody's talking about, I just want to benchmark the index. Well, indexes don't have fees, they don't pay taxes, they don't have to manage withdrawals, they don't have to do any of that stuff. It's just a phantom index. And the big issue with indexes is the substitution effect, which is GM goes bankrupt, I pull GM out, I stick a new company in, I rebalance the market cap of the fund, and everything keeps going. The index is fine. In your portfolio, you don't have that ability. You just lost money on General Motors, and so you got to go find new money to buy whatever to put back in. But Danny's right. If you take a look at any ETF, it underperforms. Every passive index underperforms its index because of fees.
And if you look at many active money managers, they're very similar in a lot of ways to the index.
Yeah.
At least the largest holdings. Now, you're going to have some that are going to overweight certain areas, which is great or it could be bad. But, when we think about investing in general, we got to think about what are our goals. I know many people, and a lot of you in the chat are probably going to yell at me and say, we want to beat the index every year. And that's great. Look, we all do. And there are going to be times of outperformance, but you cannot expect that each and every single year because, if you even look at many of these fund managers, they may have a stellar year one year, but they were overweight, let's say tech, and they didn't start to take those profits out soon enough. And, tech goes down the tube the next year.
Yep.
And so it's difficult when we're talking about, that active trade or somebody that may have a specific theme that they invest in. And we also have to remember these guys have mandates, investment policies that require them to remain invested at all times. So that's a game changer as well.
No, that's a great point. The one thing that we make as investors is the mistake that we make as investors is trying to beat the index. Oh, I want to beat the index. The best way to beat the index is to underperform it in up years and beat it in the down years. And if you can do that, in other words, and this is our mandate within our own portfolio management, our goal is to get 80% of the upside every year. So my goal is never to beat the index in a given year. If the market's up 10, my goal is to be up 7, 8, right? So if I can do that, that's great. I'm making money. We're meeting our clients' objectives. Our goal, though, is only capture 20% of the downside of the markets. And if I can do that consistently over time, and so far we've done a pretty good job of that in the years that I've been with RA Advisors, we've done a good job of that. And by capturing less of that downside, I'll wind up outperforming the index long term because I'm not spending as much time getting back to even as somebody that is just tracking an index, right? And so the secret to beating an index is not from one year to the next. It's over the long term of avoiding downturns.
Yeah, and that's the key, though. I think being an active money manager is always difficult because, I think a lot of people think Lance has a magic wand. And,
no.
I wish you did make my life a lot easier. But, I think the one thing that people need to go back to, just talking about returns in general and what we are looking at, bring it back to the plan. Bring it back to what do you need to accomplish that? What is it that you're looking? What are your objectives? What are the things you want to do in retirement? And what type of return do you need to get there? But not only that, what can you actually sustain? And the problem with this, Lance, is that, we hear from many people that I want these types of returns, but they can't stomach the volatility that's associated with those types of returns. Mm-hmm. And so I think breaking it down, getting a very good understanding as far as what it is that you actually need, we call that a hurdle rate here, to meet your goals will help you kind of say, okay, hey, we're still on track. And what I find, especially in volatile markets, while we can mitigate risk, we can never avert them, is that gives peace of mind. And there's something that's really nice about that, saying, hey, I'm not staying up at night, not losing sleep, sacrificing my health because you know that you're still on track to meet your goals. And I think that's what it should always be brought back to.
I have a big problem, Danny.
Well, which one?
I'm just curious why we don't all go out singing, pumpkin carols.
Pumpkin carols, huh?
Yeah, I mean, everybody's out singing Christmas carols. I just think Halloween doesn't get enough of a support.
Well, sing us one
after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple things, smash that like button for us. We appreciate it very much. Danny joining me talking about, it's interesting. One of the interesting dynamics of this election is potentially whoever gets elected, they get to name people to cabinet. And I thought one of the interesting kind of aspects of the Trump campaign is talking about naming John Paulson as treasurer, which is interesting. Now, if you don't know who John Paulson is a raging bull. He is always bullish. The stock market, he runs a multi-billion-dollar hedge fund. He's very successful, but he is always exuberantly bullish on U.S. markets. You never hear bearish comments from John Paulson. So it's kind of interesting, though, naming him. He says that he'll work with Elon Musk to, enact massive federal cuts. And I find that an interesting comment, Danny, because there's so much of this market rally over the last, 3 years, really since 2020, that is a direct function of massive government spending, government hiring. A lot of these employment reports that we see coming out, a lot of that is due to massive government hiring. In fact, that last employment report that was 245,000 jobs was a big chunk of that report was all government hiring. So it is kind of interesting that, you're talking about putting a person in charge of the Treasury who is very bullish U.S. markets, but then would do the one thing. When you start slashing government jobs and government spending, that's going to be a huge drag on economic growth, which obviously isn't going to be great for stocks. So it's kind of an interesting conundrum.
Well, I think the key is going to be is that how thoughtful can they be and strategic in the sense of, or do they just go out and begin slashing immediately, or do they say, okay, hey, we're going to kind of roll this. Okay, this month or this next 6 months, here's what we're going to cut. I think it's going to have to be a little more strategic than just all of a sudden just boom, pull the rug out from under it. And you're right. Think about all the money that's been flowing into the markets, into the economy from the government because of all the different jobs they've created. Now, where I think the problem is going to be is that where do these people go? And if we're already in an economic slowdown, which we are, doesn't mean that things are terrible. We're just slowing down from where we were. We see disinflation, not deflation. The interesting thing is economic data compared to where yields have gone. And if you look at inflation, Those two don't go hand in hand.
Right. Well, and look, and what I find really interesting is that so he's going to work with Elon Musk on this project, right? So President Donald Trump has already said that he wants to name Elon Musk as the head of the government efficiency department, right? So we're going to start getting the government to be more efficient. I like the idea, right? The idea is great. But here was a comment. This is a quote from John Paulson. So I'm going to work. So quote unquote, this is from John Paulson. Working with Musk to reduce federal spending, particularly by getting rid of the subsidies for green energy. All of these tax subsidies for solar, wind, inefficient, uneconomic energy sources, eliminate that. That brings down spending. But that's the one thing that has kept Tesla alive. Yeah, exactly. Has been all these subsidies. So I find that could be a very inherent conflict of interest when we get to that point. Yeah.
Yeah, absolutely. I mean, Musk's going to be like, no, skip. Let's go to the next one.
Okay, you can cut it for solar and for wind, but leave cars alone. But no, I think that's going to be interesting. But I mean, look, the idea though is that the government is too bloated. I don't think anybody argues with that, Danny. I mean, we're at $35 trillion in debt. We're spending, $4 to $5 trillion a year in the government. In fact, if you take a look at just our inflows from last year, we spent about 130% more than we actually brought in, and that's mostly to fund Social Security, welfare, Medicaid, Medicare. The Affordable Care Act subsidies, all these are all mandatory spending items. Those are items we can't reduce. That eats up 100. Just that right there, that mandatory spending eats up 100% of our revenues. So you can slash spending everywhere else in the government, but you're going to get to the point of mandatory spending, which is also interest on the debt, and you can't cut that. Yeah. It's called mandatory for a reason. You can't cut it. So you can't cut out all the other stuff, right? We can stop funding national parks. We can stop funding, some defense spending. We can certainly cut that budget. I don't think there'd be an issue of cutting defense spending budget. But there's the problem with our spending is that so much of it is encapsulated under that mandatory requirement. You can't do a whole lot, right?
Well, we can change how we do bottom line accounting, right?
Sure.
I mean, you could
actually pass a budget. That would be awesome.
Passing a budget would be very helpful. But, what about lowering interest rates? Trump was very big, and he's talked about this often, and we talked about this at the beginning of the show, that, you see mortgages at 7% again, and a lot of people saying that's an indication that it looks like, everybody's thinking Trump may win. But if he's going to come in and, he was, if you remember back in October of 2018, Powell came out and said, we are a long ways from neutral. This was just after the Tax Cuts and Jobs Act was actually put into play. And we had Q2, Q3 best earnings revenue beat that we'd ever seen in consecutive quarters, like 25% year-over-year growth for both because of all the tax cuts that people had.
Right.
And in October, Powell comes out and says, hey, we're a long ways from neutral. Market dips 10%. I think it was November 8th, if I can remember correctly. He came back out and said, he cried uncle. He said, nope, we're done.
Yeah.
And, at the time, Trump was talking about firing him because he was talking about raising rates. And market went down another 10% after that, took a breather, and then went down another 10 for like a 20% decline. Worst fourth quarter we'd seen since the Great Depression.
Right.
So you wonder if he comes in and says, hey, because he's campaigned on this, look, interest rates were much better under me. Inflation was much better. Does he come in? I think it's going to be difficult to juggle all these different parts coming out of the pandemic.
Well, look,
it's going to be a challenge.
Right. No, look, cutting government spending, government efficiency, these are great ideas, right? These are things that we need to do. I don't think there's any argument on any side of the camp that says we shouldn't be concerned about our debt levels.
Well, I don't think. I think there's a lot of arguments. They keep doing it. It doesn't matter.
There are the MMT people.
Well, I think they're for the everyday person like you and I and everybody listening. I think that yes, it's common sense. We need to stop. I don't think government officials seem to care. It doesn't matter if they're Republican or Democrat. They keep spending. Look at what they spent in the last month.
Well, I understand that, but you also have to remember that government representatives are basically influenced by lobbies, which pass these bills, pass these spendings, right? So I don't think from the common everyday person, there's not much of an argument that we need to be more responsible with our spending and how we spend our dollars and where those dollars go to.
The problem is always to your point is how do we get there,
Yeah.
and how do we do it without creating a mass amount of economic pain in the process?
Yep, that's right.
Because that's the big risk. And again, Trump has some great ideas. Kamala has some ideas that she wants to do. Those are all fine, right? The question is does it create economic growth? That's the end goal of this. It's fine to have the debt as long as we can grow the economy. But if we have debt without economic growth, that's your big issue.
Well, not only that, are they just ideas, or are they something they can actually physically get done? And that's going to be contingent on the House and the Senate.
That's correct.
I mean, that's going to be a big part of it,
Well,
outside of executive actions.
Correct. That's the other problem. So
Yeah.
anyway, real quick.
So intrinsic value, right?
Exactly. I said we'd spend a moment talking about intrinsic value, and we have just a moment.
I was going to make sure
that.
before you went off somewhere else.
No worries. The problem, we had a question earlier in the chat talking about why don't we talk about intrinsic value more? I would love to have to spend a show talking about intrinsic value. Danny, give me a stock, any stock. I don't care what it is.
Apple.
All right. So talk about Apple.
Let's do NVIDIA, because that seems to be a hot topic.
Okay. NVIDIA.
And I know its intrinsic value is going to be
well, yeah, you're kind of picking a tough stock.
low hanging fruit here.
Yeah. You can bring up my chart. I'm going to scroll around a little bit, just bring up most of the window. NVIDIA obviously is growing leaps and bounds right now. There's obviously just a tremendous amount of growth in that company at the moment. And again, you can see these kind of big jumps in both, earnings per share as relative to sales. But again, when we start talking about actual value, we're talking about a stock that trades at a 35 times price to earnings. It's extremely overvalued. But again, the question becomes, can it grow into that valuation, or does that valuation, become problematic later on? That's the thing that we don't know about the future, because it's all hinging on this idea about AI. But let's take a little bit different example, and let's pick something a little bit more kind of normal. Let's just talk about Procter & Gamble as a good example. This is just a basic staples company. Nothing nothing magical about Procter & Gamble. They make toilet paper and toothpaste and those type of things. And those are things, paper towels, right? Those are things that we use every day. Again, you take a look at EPS, right? It's growing its earnings per share. It's growing its sales on an annual basis. That's what you want to see, right? We want to see, is the company growing? They are buying back shares, but not by a huge amount. They are reducing their outstanding share count, but they're not a pervasive share buyback company like an Apple or like a Microsoft is, or NVIDIA, where they're buying back huge chunks of their shares. But again, even this company trades, so Procter & Gamble trades at almost a 5 times price to sales. That's very expensive. A decent price to sales ratio is somewhere between 1.5 and 2. You should be paying a premium for a stock that's growing. But the problem with intrinsic value today is that everything trades, because of what's gone on in the market for the last several years, everything trades at a massive premium to its real underlying value. Now, that will eventually reverse at some point, when a realization comes that we can't keep growing at these rates. We can't keep growing earnings at these rates. So Danny made the joke earlier, but he's not incorrect. The problem with intrinsic value today is you're not rewarded for investing in intrinsic value momentarily. But this is just the cycle of the market we're in. Maybe next week when Danny's here, we'll spend more of the, we'll dedicate some time on the show next week, Danny, and we'll pick a few stocks and we'll talk about intrinsic value and those type of things. So
sounds good.
All right, that wraps up the show for today. Be sure and smash that like button for us. We appreciate you being here. We'll be back tomorrow with Michael Leibowitz talking about Paul Tudor Jones and Stanley Druckenmiller. Could they be wrong? We'll talk about that tomorrow with Michael Leibowitz. That article on the website right now, realinvestmentadvice.com. Have a great day.